Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Allianz US High Yield Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the Allianz Income and Growth Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Allianz Global Investors, also commonly referred to as allianzgi or AGI, is the original asset management arm of Allianz since 1974 and was properly established as a global integrated investment firm in 2012. Allianz is the world's largest insurance company and Europe's largest financial services company, so there is definitely a high degree of business stability for Allianz Global Investors. Another popular fund provider, PIMCO, is actually also a subsidiary of Allianz, though both asset management brands run independently. As of March 2025, Allianz Global Investors has over 700 investment professionals located in over 20 office locations globally, managing about 560 billion euros worth of assets under management. Assets are quite evenly distributed across equities, fixed income, multi-asset, and private market solutions. Considering insurance company-owned asset management businesses tend to be fixed income heavy, Allianz Global Investors is rather well diversified for its exposures. The firm doesn't follow a single investment philosophy or approach, but instead is open to different active investment strategies, which is probably an extension of its history as a conglomerate of boutique investment teams. Now, the relationship between Allianz Global Investors and Voya Investment Management is a bit complicated. Back in 2022, Allianz was involved in a fraud case relating to one of its US products. The outcome of that was that Allianz transferred majority of its US onshore funds and US-based managers to Voya IM and took a 24% stake in Voya IM. For fund strategies that also has international versions, the managers who were transferred to Voya IM would continue to manage the funds even though the international funds remain under the Allianz Global Investors business. The Allianz US High Yield Fund is one of such funds that has this odd arrangement. The Allianz US High Yield Fund is a sub-fund under the Allianz Global Investors Fund or AGIF fund family. AGIF is set up as a Luxembourg SICAV company structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Allianz US High Yield Fund lists 3 co-managers in its fund webpage and fact sheet. There is, however, no further details or bios of these managers in the Allianz website, as these managers now fall under Voya IM, as explained earlier. These 3 managers actually are from the same team that manages the Allianz Income and Growth Fund, so I was able to find their bios in the Voya website quite easily. Investors who are not familiar with them may find it quite cumbersome to locate the manager details. Given this is the same manager team, I would expect there is a high degree of exposure overlap in this fund with the high yield component in the Allianz Income and Growth Fund. The most relevant manager for this fund should be David Oberto, who has been covering US high yield bond strategy in Allianz. Justin Cass focuses more on US convertible bonds, while Michael Yee focuses more on US large cap equities. So I am assuming they are named as co-managers for this fund to provide additional inputs from their respective market coverage. AllianzGI is unfortunately known to provide very little details on the investment strategy and processes of its funds. The Allianz US High Yield Fund also is currently not a focus fund, so there are no dedicated fund brochures or sales materials to help us understand the fund better. The prospectus only states the investment objective and a list of investment restrictions as seen here. The investment objective is quite straightforward, which is to invest in US high-yield corporate bonds to achieve long-term capital growth and income. We will see how much capital growth versus income the fund generates when we look at performance later. While this fund is meant to cover US high-yield market, the fund has the flexibility to invest max 30% outside of US. This can be in both other developed markets or even emerging markets countries. This basically takes on additional country risk in exchange for potential higher returns. The fund can also invest max 20% in non-US dollar bonds, which means taking on additional currency risk in exchange for potential higher returns. The fund needs to have at least 70% invested in high-yield bonds, which means it is allowed to invest max 30% in investment-grade bonds. The fund can invest in the full range of credit ratings, including up to 10% in defaulted securities. I am not a fan of high-yield bond funds taking tactical bets on defaulting or defaulted bonds to try right on the bond restructuring phase for potential upside, as that is an illiquid investment approach. So I hope this is minimal in the fund. The fund is allowed to have the portfolio duration in a range of 0 to 9 years, which is a very big range that allows the managers to either leave the duration passively managed in accordance to the underlying bonds held, or take active duration bets to try participate in interest rate changes. Finally, it is stated that the fund does not have a benchmark, which is puzzling because US high-yield bond indices are plenty and readily available. So there should be no reason not to include a benchmark index for the fund. Having no benchmark or target return objective may give the fund an excuse not to outperform, but we can simply compare it with various ETFs in the market when we look at performance later. The Allianz US High Yield Fund was incepted in 2010, which gives it about 15 years worth of track record. Fund size is currently around 457 million US dollars, which is considered small given it has been around for 15 years. Sector allocation breakdown is showing subsectors directly, so there is quite a long list here. The largest sector exposure is financials, which is quite different from the broad high-yield market, where consumer sector tends to dominate high-yield bond issues. The next one on the list, energy, is more expected, given mid-cap energy companies tend to issue high-yield bonds as a reflection of the high-risk, high-return nature of the business. More important to note is the credit rating breakdown, where we can see the fund is still mainly exposed in BB and single B rated bonds, with 87.9% in total. There is also a 0.7% in BBB investment grade and 4.1% in liquidity or cash equivalents, so these are fine. The remaining ones, assuming they are CCC and below, plus defaulted bonds if any, total to 7.5% exposure. This means the fund is not taking excessive risk in the riskier bonds, despite the fund guidelines allowing it to do so, which is good. The fund webpage and fact sheet does provide top 10 holdings and they total to around 17% of the portfolio. The portfolio currently has 95 holdings. Given the fund size is not too big, this can easily grow to 200 holdings and beyond if fund size expands. The fund also provides some basic bond portfolio statistics. Here it states the average credit rating is BB-, which again reflects the fund is not taking excessive risk. Yield to maturity is 6.57% and average coupon is 7.07%, so we would expect the fund to have a distribution yield similar to these numbers. Effective maturity is 5.65 years and effective duration is 2.89 years. Though without a benchmark, it is hard to tell how different these statistics are compared to the market. So let's throw in a comparison here. This is the iShares iBoxx US Dollar High Yield Corporate Bond ETF, which is one of the largest US high yield bond ETF in the market. The yield to maturity of the ETF is 6.89%, which is just slightly higher than the fund. The weighted average coupon is 6.49%, which is slightly lower than the fund. Effective duration at 2.86 years is near identical to the fund. Weighted average maturity is 3.56 years, which is much lower than the effective maturity of the fund, suggesting that the fund is going for longer tenor bonds, possibly with higher coupons. We can also get a bit more details from Morningstar, where it shows the portfolio has nearly 90% in US exposure, with the rest in Canada and Europe and a very small exposure of less than 1% in Latin America. So again, the fund is keeping quite true to the US high yield exposure in the portfolio. The Allianz US High Yield Fund has a retail AT accumulation US dollar class, but is strangely not offered in Singapore. The share classes offered in Singapore are mainly the retail AM monthly distributing classes. Perhaps allianzgi thinks that no one would be interested in going for accumulation class for high yield bond funds. Besides the base US dollar class and Hong Kong dollar class, the rest of the currency classes are currency hedged and denoted with H2. These currencies include Sing dollars, Aussie dollars, Canadian dollars, CNH, Euro, and Sterling. The base US dollar class was launched in 2010 when the fund was incepted. The other classes were all launched shortly after in 2011 to 2012, so they all have a decently long track record. The retail AT and AM class have a 1.19% management fee. Adding other expenses gives a total expense ratio or TER of 1.24%. Up to 50.42% of the management fee can be paid by allianzgi to distributors as trailer fees. Distributors are allowed to charge up to 5% subscription fee for the fund, although I think anything more than 2% for mutual funds is excessive. The Allianz US High Yield Fund provides annualized distribution yields of its AM share classes in the fact sheet, which is good as not all fund providers make this data easily available to investors. Assuming there are no undisclosed arrangements, these are based on net distribution policy, meaning the differences in the distribution yield of each currency class versus the base US dollar class is due to the currency hedging cost that has been factored and deducted from the distribution. So for example, the Sing dollar class currently has a currency hedging cost of around 1.57% per annum. I like the net distribution policy approach, as the costs are factored into distribution instead of NAV, so that more capital is retained in the NAV for future growth. If we also revisit the portfolio statistics, we can see that the current distribution yield of around 6.09% is below the average coupon or the yield to maturity of the portfolio, meaning that this distribution yield is sustainable by the natural coupon yield generated and the fund doesn't need to sacrifice any capital to top up. This is also a good thing, as it means more capital is retained in the NAV for future growth. The Allianz US High Yield Fund has a dynamic performance chart in its webpage, which is a little useful, although we can't add any additional items, so we can't really use it for any comparisons. What is useful to note is that the fund performance, representing the US high yield bond market, has been on a gradual growing trend since its inception, going through various market events such as COVID in 2020 and the sharp interest rate hike in 2022. So this shows that the US high yield bonds can exhibit significant volatility at times, but the rebound can be strong as well. There are also calendar year returns and cumulative and annualized returns across time periods available, though again, the fund has no benchmark defined, so we can't really tell just from this data whether the fund is doing good or not. So let's do some comparisons using Morningstar. Glaring performance gaps start to show once we train comparisons. Here is the Allianz US High Yield Fund compared to both the US listed version and the Europe UCITS version of the iShares Dollars High Yield Corporate Bond ETF, and we can see significant underperformance from the Allianz Fund. Reducing the time period to past 5 years shows significantly lesser underperformance, so we can deduce the bulk of the underperformance resulted in the time period prior to this. However, we can still see here the fund tried to stay in line with the ETFs in 2021 to 2023, but started lagging again in 2024 and year to date. Here are some of the other popular US high yield bond funds available in the market. Using the same 5-year period, we can see Allianz is one of the weaker performer in the list, winning only PIMCO during this time period. It is also worth noting from the returns numbers that none of these funds have managed to outperform the ETFs during this time. There are also the diversified bond funds such as PIMCO Income and M&G Optimal Income as examples here, that have managed to deliver returns almost like high-yield bonds but without taking on the associated high-yield credit risk, giving investors an additional consideration of whether it is really worthwhile going for pure high-yield bonds for the risks involved. So high-yield bonds definitely have a hard time in the current market conditions. With that, let's summarize our findings. Allianz Global Investors is the asset management arm of Allianz, the largest insurance company globally. The business AUM isn't as big as some of the other fund providers, but having a big size parent helped to ensure stability of the business. While brief explanations of the allianzgi and Voya IM arrangements are available, there is simply no details on the fund managers in the allianzgi website and documents, which is not ideal. While this is a rather straightforward fund, there are no details available on the investment strategy and process. It would be useful to provide, for example, some elaboration on how risks are managed as part of the portfolio construction and bond selection process, so that investors can understand the fund better. The fund portfolio appears to be avoiding excessive risk by keeping to mostly higher credit-rated bonds and US exposures, despite the investment guidelines allowing for higher degree of flexibility. The current distribution yield of around 6% per annum looks to be sustainable by the natural underlying coupon yield or yield to maturity of the portfolio, which is good. Performance of the fund is a concern, having lagged behind most peers in the market as well as passive ETFs. The team needs to improve the fund performance to make it more competitive. At the moment, it appears that going with passive ETFs is the optimal approach from returns perspective when it comes to US high-yield bond exposure. Even if you would consider non-US dollars investments, there are currently other better performing competitor funds available, so allianzgi needs to do better. This concludes my absolutely biased comments on the Allianz US High Yield Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.